Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with this Thursday guest, Mr. Jonathan Flomley. How you doing, sir?
I'm doing great, Michael. Thanks for having me as always.
Absolutely. So as we've kind of teased, or you successfully teased at the end of episode number 2, episode number 3 today is a big one. I think I've had a couple of conversations yesterday. A couple of conversations do make at least, you could call it a trend. It's probably pretty early, but I'm going to ask the audience if they are seeing the following as well. And that is, Jonathan, I think mom and pop, first-time buyers out in the market are giving up. I heard that multiple times yesterday. I think the demand picture has cracked. It's not going to lead to an immediate crash. It will lead to the slowdown that I'm referring to. But as you mentioned, it was a cascading of negativity. We weren't really impacted earlier in the year when assets were going up because, again, interest rates were low and it was payment. But now we've suffered significant real inflation, meaning consumer inflation. Now interest rates on 30-year debt, Jonathan, are up 1.5% from the bottom.
Wow.
1.5, almost 1.75 as of, what is today, Thursday, as of Tuesday. Mom and pop are upset now. I had a couple of brokers, both in the West Coast, say, I've had multiple buyers call today and said they're out. They're not playing anymore. The market's too crazy. It's too hot. Debt's too expensive. Groceries too much. I think the buyers are just starting to revolt. So what do you think of all that?
Well, yeah, I mean, that I'm not surprised if interest rates have gone up by that much. That really hits the bottom line.
Absolutely.
And it really affects affordability. And frankly, the banks, we talk about the debt service coverage ratio a lot on this show in terms of multifamily real estate and how the higher the interest rate, the more you have to pay at the same price, right, for meet your debt service and how much more the banks want you to cover. But the banks, we don't really talk about the banks underwriting you for a home purchase, right? But it works the same way because the banks are looking at, okay, if interest rates have gone up by almost 2 points, that really impacts your payment. And then that whole metric of no more than 33% of your income, well, suddenly you've got to make a lot more money or you got to take a smaller mortgage, when interest rates go up. So a lot of people who are thinking, hey, I could afford a house priced at X, are now seeing the banks tell them, hey, you can only afford a house at, X minus.
Yep.
Right. So, and that has a big impact. And for people who are, like you said, kind of have an oral agreement on a house or something, and suddenly the bank comes back and says, hey, we're not going to loan you the money because you can't afford it, or this is what your payment's going to be, and they get sticker shock, yeah, they're going to be pulling back. So I'm not surprised at all to hear this. And just in terms of what I'm seeing, and I follow some single family home markets just because I, want to buy vacation houses there or what have you. I've seen a couple price cuts recently, which I was surprised by. And I think it's because there's been a pullback in demand suddenly now that money, while still cheap by historical standards, is suddenly not as cheap as it was a couple months ago. And that's, nobody cares what historical standards are. They care about what they were expecting, and they were expecting it to be cheap because that's what it was a couple months ago. So, not affecting. I had a conversation with a friend who's a high-end condo. He does condo conversions. So what he does is he buys brownstones and in Brooklyn and converts them into condominiums.
Okay.
And very high-end stuff, sort of $2 million price tag. That stuff is, the market's still rising in that end of the market, but I think at the lower end of the market and some of the towns I'm looking at, you're starting to see some softening perhaps.
Yeah, again, this is just all predictable. And it's why I've been calling for a housing slowdown. And again, I try to educate people on what I see. So again, we haven't had a supply problem. I know people point at supply and say supply is down, and realtor.com and Zillow point at record low inventory. But again, if supply was truly down, we would have seen less transactions. What we really had was a crazy demand picture, and hence the supply was consumed faster.
Mm.
That's what it was. It was a demand on steroids, or whatever you want to call it. And now what we're seeing is the cracks, and it's predictable. Interest rates are up 1.5%, which means for the average kind of first-time home buyer, your purchasing power is down 12 to 17%. In an environment where real estate is up 15 to 20%, that's a horrible, double dip pain. And then you're looking at your gas and your childcare and your food, and you're like, I was stretching before, and now it's now it's impossible. And oh, by the way, even if the bank still says yes, a lot of you are going to say no. So this is how it all starts. Buyers retreat. And just this week, I've been tracking this every week. Just this week, people are coming to me going, I think it's happening. And again, what this means is people hear me talk about this and they go, oh, the crash is coming. No, the crash is not coming. What's going to happen is we're going to go from 18 days on market and like 5 pieces of real estate to 15 pieces of real estate in 31 days on market. And then we'll have 29 pieces of real estate and we'll have 42 days on market. We are going to work back to a neutral market. It will take months and probably quarters to get back to neutral. So there is no chance of price deterioration at a national level this year. Could a city or two go negative? Sure. But yeah, this is how it starts though. And for investors like me, I've been waiting for this because I can finally start to comb through listings and find that motivated seller who has to sell. Not I'll sell it at 300 if somebody wants to pay, else I'll take it off. I don't want that person. I want the person that's like, I need out. Okay, I'll take 270 because it's the only offer I have. Right. That's what's coming, I think.
Yeah, I don't disagree with that. I wanted to also, I mean, just to like a further point on that, like I don't disagree that there's going to be a crash, because as long as the jobs picture continues to be the way it is, there's no reason for there to be a substantial, like the bottom falling out of the demand, right? Mm-hmm. This is more around the margins,
exactly,
where certain people are being priced out, or they're just giving up, because it's gotten so crazy, and that will kind of cause demand to soften. And as you said, as an investor, this is a better picture. The thing to worry about is if we have like a real recession where there are real jobs lost, and even then, even in a recession, you won't see an across the board crash. You'll see worse things happening in markets that are more affected, right? And some markets will not be that affected at all. It won't be across the board like in the great financial crisis, where what happened was basically the banks just stopped lending. Period.
Exactly.
Right? Yeah. And that's a very different kind of scenario. And
we're not there.
And hopefully we don't get there. But the one thing, it's been interesting. I don't know if you follow, Fannie Mae, if you subscribe to them, to their emails, which come out sort of randomly sometimes, right? They sort of send an email once in a while out of the blue. But they track through polling, good time to sell, good time to buy numbers. You see those? And so it's been, so for quite some time now, people have already been saying, it's a bad time to try to buy a home, right? Because prices have been so high. That was before these interest rate increases, right? So I'm sure that number is going to go up. However, what you're going to see is the good time to sell numbers, right, starting to fall, right? Because the sellers are not going to be so much in control. So you'll see that coming a little bit more into equilibrium, where people may continue to think it's a bad time to buy, but more people will think it's a bad time to sell. Sure. Which will sort of even things up, right? So that'll be an interesting number to follow.
Yeah, and then I go back again, residential guy here. You're the commercial apartment guy, and I start to go back and think about if we truly go on a 18-month or 24-month slow tick up in interest rates, where the Fed fund rate eventually gets to 3 or 3.25. What does that do, if anything, to cap rates or the multifamily market? Does the multifamily market still keep screaming higher and higher? Or does this communication of higher rates into the future somehow dent the value of commercials?
I mean, it's going to depend on rent growth, really, right?
Yeah, the
Like,
NOI. Yeah.
Yeah, as long as if NOI, if net operating income continues to rise, it may be able to absorb
Okay.
some of interest rate hikes. Especially if the interest rate hikes are gradual. Like, I think, frankly, if interest rates spiked by, and we're going back to our first conversation,
Sure.
if interest rates went up by 0.5 point in one session, especially when the market was anticipating a 1/4 point, that would have had some serious consequences for the commercial property market.
Yes.
Particularly for deals that were already in contract.
Agreed.
Right? Yeah. So, where you hadn't locked your rate yet, now suddenly you're looking at a 50 basis point rate hike plus whatever spread the bank tacks onto that. And suddenly you're talking about a whole lot fewer proceeds than you were anticipating. Right.
Sure.
And this is major, right? This is a big, you're really over a barrel if that happens to you when you're already in contract, right?
Yeah.
So that I don't know how much that played into the Fed's thinking, if at all, but it's certainly something that the commercial property markets were probably watching pretty closely.
Yeah. Again, I think this is back to our first conversation. I don't think the Fed wanted to surprise anybody. I think they slow and steady is the way of the land. It's just going to be I don't know of a better analogy. I wish I had one. It just feels like they're going to rip the Band-Aid off one hair at a time, and it's going to be slow and painful and last a long time. I don't know.
Yeah. I mean, listen, we can't avoid recession forever.
No, you can't. You can't. No.
But the Fed has been trying for several decades to.
Look at California's forest. We didn't clear the timber, and eventually we got.
Exactly. That's how it works.
Yeah. This has been a lot of fun today, Jonathan. I appreciate your time. Where can people find you?
Yeah, so come join me in my free Facebook group called Multifamily Investment Community. Just go there.
It's a great place to be.
Sign up, and I will let you in. What else can you do? You can, if you would like to get on my investor list, if you're an accredited investor, Google Two Bridges Asset Management LLC, and you'll find the investor form where you can sign up. And finally, if you would like to join my coaching program, you can go to multifamilylaunchpad.org/join and see all the details there.
Awesome. Thank you, Jonathan, for all you do.
Thanks, Michael. Take care.